Hi, welcome to 5-Minute Financials with Jack Driscoll. Invest 5 minutes of your time with me to improve your financial well-being. Let's start. Now let's talk about something called universal life. Universal life insurance is a combination of term, annual renewable term, with an excess premium charge going straight into cash value, a cash accumulation account. Now, cash value is an excess premium that was not needed to cover that year's insurance costs and the insurance company's expenses. So let's say it would cost, and as I said, all policies are built on an annual renewable term chassis. So let's say you were purchasing $100,000 life insurance, and an annual renewable term at your age 30, let's say, might only be $80 for the year. So you go to a company and you say, I want to buy a policy that lasts longer than that. And they talk to you about many different forms of insurance, and then they hit on one called universal life. And you say, what's the difference? And they say, well, universal life builds a cash value. And you say, does that run out like those term policies in 30 years or 5 years? They say, no, that policy is oriented to last forever. And you ask, is it guaranteed to last forever? And the companies typically say, it depends on the premiums that you're giving. So if that sounds complicated, it's because it is. So what you do is you ask them for this. What's an illustration for guaranteeing me that my policy will last to age 100, let's say you'd ask them, or age 120, on a guaranteed basis? And then you would also ask them, I'd also like to know what the premium would be on current assumptions basis to last to age 100 or 120. Folks, that is an excellent, excellent recommendation right there. If you just ask for those two things, you will get the whole picture on universal life. Now, universal life insurance is designed to last your whole life, but it is not typically guaranteed to last your whole life. So what can go wrong are the rate increases for the life insurance portion, which does increase every year, might increase too much over the initially estimated annual premiums that they thought would be enough to cover it. And the cash value interest rates might also become lower than initially projected and make the policy what we call blow up or run out of money or run dry, run through all its money, deplete its resources, and go broke. The policy would go broke, not the company going broke, but you could lose the policy. And you could find out at age 80 or 78 or so, hey, your policy is going to run out for insufficient funds, and it's too late to do anything about it. So get those reports I recommend early before you purchase, and you'll know exactly how much premium you have to pay every year if you want to guarantee the policy never cancels or lapses by age 100 or 120. And you'll also have another proposal that says how much the annual premium would have to be based on current assumptions. If you would say, well, I don't want to pay that much to guarantee it, but based on current assumptions, how much would I need to pay every year to be pretty certain the policy won't run out of money on me? That's universal life, folks, and you'll run into, if the policies run well, an interest rate on the cash value account, which is the excess premium every year above, let's say that $80 I used as an example. You might find your annual premium being proposed is $300 a year, where only $80 of it is needed for this year's life insurance portion and the company expenses. Where does the rest go? $220 goes straight into a cash value account for you that is building inside your policy for you. And it is also earning interest for you. And that cash value account grows and helps subsidize future increases in premiums. Designed properly, It can last forever and be a permanent form of life insurance for you. Remember, it only takes 5 minutes to improve your financial well-being. Check back soon for more 5-Minute Financials with Jack Driscoll.